works. Hello? Can anyone hear me? I'm trying to make sure that you can actually hear me. Here, hold on 1 second. This should work. One second. Here, hold on. Can anyone hear me now? Can you hear me now? Can you hear me? Ah, there we go. Hopefully you can hear me. Is anyone here? All right. Sorry, I actually started, when I tried to start it, it didn't actually work originally. So now it should work. Hopefully this is all working now. All right. Yay, thank you guys. Oh, Stan, so good to see you. Stan from Quora Days. Wow, love seeing you. Follow Stan, anybody on LinkedIn or wherever he is. A really interesting guy. I'm so glad to see you. Anyway, thank you, Mahit. I really appreciate it. All right. I am going to just make sure. So I am also trying to multi-stream here. And ordinarily, like the last stream I had, we had like 350 people. That were viewing this at the same time. So we'll see how this goes in terms of the multi-stream. I'm just going to make sure that it's also up. Hold on, it's supposed to be streaming also on X. Let's see if that's actually happening here. I can't tell. Hold on. Did this actually start here? I'm just going to say should be live streaming now. Live streaming now. I have no idea, to be honest. I'm going to see if it is. I just posted it to see if it's actually live streaming, but I don't know. I will try to keep my mic on for this as well. And we will see if this works if I do that, because I'm not entirely sure how this is supposed to work. But that sounds really annoying if I actually keep that here. I'll put my sound down on that, because otherwise that's super annoying, right? Because you all don't want to hear the beeping and whatever. So I'm going to try, and hopefully they can hear this as well. Actually, I have a little thing to make this work as well. Okay, you guys, be patient for 1 second while I try and make everything work for everyone, because I'm that kind of a person, trying to make everything work for everyone. So let me just here. I think that I can. Where's my adapter? That's painful. I have an adapter here. I do. I do not have anything in here. Where is my adapter? This is why kids should not be allowed around any of your stuff, because they move everything. Ugh. All right, let me see if I can find my little adapter thingy. Oh, I found it. All right, this was not my kids. This was me. Okay, all right, let me do this. I think I can do this. There. You guys should be able to hear me. There we go. You guys should be able to hear me on there, which should work. And it should work on the live stream. I have no idea if there's an actual live stream happening, but I will check to see if there are questions or anything that are also happening on the on X, because it's just easier to get questions on X. I'm not really sure how this is all going to work, but I'm going to do my best. Okay, let's get started, because there's a lot to cover here. And I don't know if people are going to actually, I'm not really sure about the live stream part, but there should be actually a live stream that's happening on X. Stream is live on X also. Oh, good. Can I close that space? Because I'd rather not have the space open. I just have the live stream. If I can close the space also, if there's actually a live stream happening as well, then I can close the space. That'd be nice. I don't know if it's actually happening. If I can close the space, then I'm going to do that. Guys, just tell me if the live stream is actually happening on X, because then I can actually close my space. But I don't see it. Well, I don't see it. I have no idea either. So I don't know if it's actually streaming on X as well. It should be, but we'll see. Anyway, this is kind of a pain in the ass. What a freaking pain in the ass. Okay, whatever. I'm going to do that. Okay. All right. I don't know if you guys can, theoretically, y'all can hear me. Okay, let's get started. Let's talk about tokenization. And thank you all for joining me. I'm Alexandra Damsker. I'm a corporate and securities lawyer. I used to work at the Securities and Exchange Commission. I worked at a big firm in their New York and Chicago offices. I managed a practice. I ran a few companies, and I exited. I moved into blockchain in 2016, AI and quantum computing in 2019, because they're all coming together. And originally came into blockchain in order to build a company. That actually didn't work out, because when I came in 2016, there was just Ethereum and Bitcoin. And even though I wanted to build a financial marketplace, I finally realized that no one was going to wait 9 hours to close a financial transaction. So we bagged that. And but anyway, I was one of the few people that understood operations and regulation, and so I ended up speaking on a lot of stages and helping in a lot of platforms and protocols. And I became this de facto consultant to like funds and protocols and all sorts of different people. And eventually I was asked to write a book on finance and DeFi by O'Reilly, which is this big business publisher. And that's called Understanding DeFi. And that is by O'Reilly. You can get that book. It's actually really helpful if you don't understand finance or blockchain or DeFi, how it all fits together, how to build in that area, how money is made in that area, where the risk is, what the risk profiles should be, so you know whether or not you're getting into too much risk. Something looks like it's a scam or something. I'm extremely good at calling scams. I've got a really long track record of it. So if you want to know why, it's because I have a lot of references for where scams are and what numbers should look like. So knowing what something should look like really helps you when it comes to understanding what looks wrong, right? When you understand what something should look like, when something looks really wrong, you have to say, well, is there something compensating or explaining why that looks wrong? If not, then it's probably either a scam or run by people who don't know what they're doing. Either one of those is not a good idea for you to invest in. And so that is generally speaking how I manage this area. And anyway, so I've been working in these three areas for quite a while now. And our next discussion is on Thursday. I'm actually changing the time to 4 p.m. Pacific, but it's on AI and intellectual property and protecting your assets and what assets you should protect and which ones you shouldn't, and how to actually create IP that is safer from LLMs, like how LLMs actually work. Because as much as you can rely on some law, right, to protect your intellectual property, it's actually better to understand how the technology works so that you design your IP so that it's harder for the LLMs to actually pick it up, right? And then when you are actually using an LLM, it's actually better for you to understand what's safe and what's not. So we're going to talk all about that. And it's really important for anybody who is, doing anything where they have a brand at all. And that's most people. So that's next week. I think on, what is it, the 26th, I'm going to say. I'm not sure, but it's on my profile if you look for events. The next one, it's AI and generative. It's like generative AI and intellectual property, something very cleverly named like that. That is coming up. Okay, So right now, I'm the chief legal officer of a company called Populous, and we are doing some interesting things, partially with tokenization, but it's really about helping first and family wealth. It's an exclusive membership club. We do have an interesting take on some tokenization. There's an aspect of it that has tokenization. So one of the things in here, you'll see that there are some problems in this area. And we're actually solving one of the primary problems in this area, which is something very interesting that I find very interesting, because most people aren't even really looking at where are the problems and how do you fix them. They're just saying, well, there are problems and we're not going to touch it, as opposed to saying, well, there are problems, but they don't have to be problems. So let's talk about what this area is. And how it actually works. Tokenization fundamentally is making something in the real world, usually something in the physical, tangible world or intangible world, like something that you would ordinarily have as an asset, some asset, or some debt, right? But something that has usually, right, a financial attribute to it. An ownership and financial attribute to it. You are turning that into a token, right? You are representing it, instead of with paper, you're representing it with a token. Now, why would you do that, right? Why would you represent something with a token instead of with paper? There are some of the standard ideas, right? Which is, well, there's no middleman. There's, it's a way to basically do transactions faster. Now, faster is always a good thing when you're dealing with lots of money, right? Cheaper, again, always a good thing when you're dealing with lots of money. And no middleman. What does that mean? Again, cheaper, right? You don't have to rely on someone else to approve a transaction or to say that a transaction occurred, which means you don't have to pay another person. That's called disintermediation, taking out a third party. When a disinterested blockchain, which is really all blockchain is, right? What is a blockchain fundamentally? It's really a third-party observer that approves that a transaction happened. So you say, I have a bale of hay and you have 3 goats, and I buy your bale of hay, or I buy your 3 goats with my bale of hay. And if we do it on the blockchain says, yep, that happened. That's really all it is, right? It is an accounting method. It's a third-party accounting method that is disinterested. And what it can do fundamentally, it's what they call, it's a momentum accounting, right? So it really, what it is an innovation on accounting, which we haven't had since the Venetian accounting, which was an innovation in the 13th century, right? So that was our next innovation, our last innovation, that happened in accounting, was when we had double entry bookkeeping, right? Which was not just one person saying, you owe this to me. It was someone saying, I did this for you and you owe this to me. And then the other person saying, I did this to you and you did this for me. And we can match, right? We match up our assets and our liabilities, our responsibilities and our benefits, right? We match those up. That was the innovation from Venice. And we've literally had no other innovations in accounting since then, right? The innovation that we had with blockchain really is having a third party saying, well, if you're doing something, I don't need for my books and your books to agree, right? We do this. I'm going to sell you something, and neither of us have to have records, because the fact that we made the transaction on the blockchain and the transaction went through means that, first, I have a bale of hay, and second, you have 3 goats, And third, we agreed. That's what the closed transaction means. It means that both of us have the value that we claim we have and that we agreed to transfer it. So a closed transaction means that not only do we have the value, we're not lying about what we have, but also that we agreed to transfer it. So that is a huge innovation in accounting, which is not actually something that accounting previously could do, which is test the value in the books, right? Testing value in books was something you needed an independent auditor for. And things like attestations don't do it. You need an actual audit saying, where are the receipts? This is something saying, I see the receipts at the time, and that's the only way that the transaction can close. This is such an important innovation. This is why this technology, and for everyone who's saying like crypto is good or crypto is bad or whatever, that's all this really is a back-end technology where auditing fundamentally is irrelevant. Think about the cost that you save in terms of auditing. Think about the trust that you save in that regard, right? The fact that you don't have to audit transactions, you don't have to prove that someone who is trying to purchase something in a time differential it has what they say they're going to have, right? So my hay is not actually harvestable until the fall, but your goats are ready in the spring. Crap. How do we do this? Because we have a time differential. This is a problem, right? This is a problem. Now I have to trust, right, that either, right, now the goat person who comes to me and says, I have 3 goats now, well, they need hay, but they can't get it right now because it's not fall. So, but their goats are ready now. So they can sell them, but then they have to trust that I am going to deliver, that they're going to actually be able to bring some receipt, and that I am going to recognize that receipt, and that I'm going to have the hay to deliver. That's a huge amount of trust that has to happen, right? And so far in market economies, it's generally worked, but it has had huge problems, right? What if someone steals the receipt and then you give the hay to the wrong person? What if I die and my child doesn't know who you are and doesn't recognize the receipt? What if you lose the receipt, right? There are all these things that can happen where the idea of having to transfer something that is rightfully yours can't happen because there's some measure of trust that has to be met that can't be met, right? And so this is a fundamental friction in market economies that blockchain actually solves, right? Which is the ability to transfer assets and transfer debt, right? Transfer obligations between parties without having the element of trust, even when there's a time displacement, right? Even when there's a time displacement, there's still this ability to transfer because you can transfer a debt obligation as well, right? Now we get into tokenization, because what is a token really? So token is really just something that makes a transaction go on a blockchain. It's really like a toll. That's all it is, right? So for people who aren't familiar with how blockchain works, think of blockchain like a toll road, and tokens are just tolls. Coins and tokens are fundamentally the same. Coins go on layer 1's the base layer, and tokens go on everything else layer 2 and above. And those are, but fundamentally, you don't need to know about that stuff. You really just want to know that these tokens or coins are really just the toll for going on these roads, right? They're the thing that you pay in order to move things along on a blockchain, right? That's why they have value. Why? Because you want to drive on the road. Now, here's where things have gone awry in blockchain fundamentally. we need to build roads that people want to be on, either because they go from New York to Miami, right? Who cares how scenic that route is? Everyone wants to be in New York and Miami, and they're going to use that toll road to go, right? It could be the most boring stretch of land. Who cares? But that's where people want to be. They need that road, right? So fundamentally, because everybody wants to be in New York or Miami, they're moving back and forth between those two. The other thing is, well, let's say you've got a road between, and I mean no disrespect to these towns, like Omaha to Peoria, right? Not really big tourist towns, right? So you've got this road in the middle of nowhere. Why would anyone use it? Well, it's got a movie theater, and it's got a spa, and it's got like all sorts of casinos, and it's got all the biggest entertainers perform in this incredible theater there. So you've got all the crap that everyone wants to go to there, right? So that one can command a ton of tolls. Why? Because everyone wants to be on that road. No one cares about the entry and exit points, but they super care about everything that's on there. So you've got one of two options. Either it moves from a one point to another that everyone needs, or it has everything on it that everyone wants to use. So far, we've only had one that exemplified either one. And then we've had a few that actually had bits and pieces of these things. But fundamentally, people have been forgetting what these tokens represent. In and of themselves, they're not necessarily as valuable, right? They're valuable in connection with the chain itself, with the movement, with the blockchain, right? They have to be intrinsically tied to the nature of a blockchain. If you could do whatever it is that you say you're doing with a token better, faster, cheaper, easier on a centralized database, that token is fundamentally useless, right? If you could do it better, faster, cheaper, easier on a database that's centralized, there's no need for a token because it's expensive and it's slow, right? Right now, things aren't super fast. They're getting faster, right? But they're not super fast, and it's more expensive. Why would you do that? Because you want one of three things. There are three things blockchain does better than any other technology: ownership, finance, and identity. That's it. Anything else does not require a token. Anything else does not require a token. That's it. Right? So tokenize the world is stupid, fundamentally. So knowing this, we take this statement, tokenize the world is stupid. It is really only valuable in identity, ownership, and finance. Now, we go from here to this other piece, right? When we're talking about tokenization, we talk about fundamentally a couple of things. When we're talking about identity and ownership, we're usually talking about whole parts, right? Identity and ownership are generally tokens that are whole pieces where you're actually dealing with fundamentally how do I abstract my identity so that it is a known unknown, right? So that it's knowable, but not necessarily known in a particular transaction. How can I make my identity something that is easily accessible in specific circumstances, but not necessarily publicly available? Things like that, right? How can I make my identity something that is a functional tool, but not necessarily completely available? So I could have a token of identity, but that token gives me access, but doesn't reveal information, right? So kind of a ZK proof for those of you who are familiar with that term, right? Something that you have to parse together several pieces in order to get the actual information. But generally speaking, like if I have the right token, I can gain access to an 18 and over thing, or I can gain access to a VIP room, or I can gain access to specific things. But it doesn't mean that the person at the gate, like the VIP guy, doesn't have to know my name. right? He just has to know that I have the right token. So that's the identity piece. The ownership piece is essentially, do I own something, right? And generally speaking, that is encompassed by holding the token and wallet access. People fear wallet access because they're scared that they won't have the keys, that they're going to lose the keys, that they're very scared about this particular thing. This is also training, right? We had specific training after the starting from 1936 on, that there was this huge push that essentially put the fear in people that we couldn't handle our own money. This is actually a long story, so I don't actually want to go in too much detail of how this actually happened, but this was, so post-depression, most people did not want to put their money in banks because of the run on banks. Then there was this active effort to encourage people to put money in banks. Why? Because without money in banks, the economy slows to a halt. China had the same problem. People put up to 30% of their income in home savings, like coffee cans, things like that. They did not trust banks or other economic systems that held money, even when they added large interest rates, right? So they started doing things in banks, like giving away toasters and things like that, like consumer goods. They started doing a lot of things to encourage people to open accounts in banks. And part of that, it was a carrot and stick, right? So the carrot was, here, open an account, I'll give you a toaster or a blender or whatever it is, right? They gave them goods and then gave them a little bit of interest, but mostly it was giving them consumer goods that were sponsored by Hoover, sponsored by whatever it was, right? Frigidaire, or I don't know what the makers were in like the 30s and 40s. It's before my time. But the other thing that they did was the stick, where they said, you will lose your own money. Banks are safer than you, right? Think of how well you've done on your own. And the problem is, people generally doubt themselves. And this we've seen even in AI, where we have experts against AI, and experts doubt themselves even when the AI is wrong. Humans have a level of self-doubt that is nearly overwhelming. And if it's pushed on, particularly in a systemic way, then generally speaking, people cave. And most people don't have financial education. Like, that has come out, that has not ever really been a part of our school system. The most that we've ever had in our school system in the US was home economics, which was budgeting. But we didn't have economics in terms of financial economics. That was actually something that the wealthy had. Only it was like parent to child. And for people who didn't have parents who understand financial economics, then you were screwed. That was basically it. So the push to say you don't understand how money works, most of them were like, absolutely, I don't understand how money works. And so money went back into banks. Anyway, all of this to be said, that that most people are very afraid of holding their own money, and of mishandling it. And this is a very old idea, right? That in our society, relatively speaking, this is something that's kind of purposefully built into our society, and is very difficult and kind of intractable in some ways. So just to let people know that if you feel like I can't trust having a wallet, or I can't trust myself with keys or things like that, that is a very, very common idea, and is something that you are trained to believe. So you have to believe that if you are trustworthy with your own house keys, you are trustworthy with your security key. Like that, you are trustworthy with your wallet. There is no reason why you can't hold your own tokens or other things, but people get very concerned. All right, moving on from there. So let's talk about the last piece of this, which is financial. When we're talking about tokenization, and we use it in this term tokenization. Most of the time, that term tokenization is really about this financial piece. We're really talking about a derivative aspect, right? And we're separating out something like the obligations or benefits of something, and how to essentially pull that out of ownership, right? Either taking a piece of ownership or a piece of debt or something like that. We're separating out a stream of payments usually. And that is what we're talking about when we're talking about tokenization. It is nearly always the financial aspect. And finance works better with tokens. It does. It's cheaper, faster, and better. And that is one of the things that that people don't really understand about tokenization is it allows your assets to continually move. Your assets should never be sitting. Your assets should always be moving. Your assets should always be working for you, incurring some sort of benefit. So one of the things that we want to talk about here is what is the main issue with tokenization. So what we're talking about is when you tokenize something, you are essentially taking a piece of something and you're talking about taking the benefit of payments from that thing, right? That's really what you're talking about. Because when you tokenize, say, land, or you're tokenizing art or something like that, you're not saying, I want you to cut out 1/100th of that art piece and give it to me. You don't really want ownership. What you want is the benefit of a stream of payment. If you're talking about you want a piece of land, you don't really want like a 1,000th of that piece of land. Here's that little piece of ground for you to do something with. It's really, I want a fraction of the stream of ownership benefit. I want a stream of cash from there. So what we're really talking about are derivative benefits of ownership. That's it. So if you're fractionalizing something like debt, you're also talking about a derivative payment from debt, right? That's what you're talking about. So these are derivative benefits that you get from tokenization. And that is actually a very different thing than ownership. So there's where we are in ownership. So we have a few issues and problems with asset ownership, right? Or with this derivative ownership. And the first thing that I want to mention in this, and I'm trying to, I know a lot of this is simplified because I'm trying to make sure that I hit enough points, but I don't keep everybody here forever because there's so much to talk about here. And please, if you've got questions, post them up on the feed. I'm going to try and make sure that I get any of like these questions here, if there are any questions in this. Hold on. Let me just see. We can't hear. I'm not able to hear. We can't hear you. Uh-oh. Shoot, something happened with that feed. Whoops. All right. I don't know if it actually didn't work on X. Oops. I'm very sorry for people who if it didn't work on X. I don't know what happened. I think the feed collapsed. But that's why I do it here, because the feed there is not very reliable. Okay. So I'm trying to make sure that I get as much done as possible here without actually overwhelming anybody. But okay, so what is the distinct value proposition for tokenization? So a shared system of record, flexible custodial arrangements, programmability, asset fractionalization, and composability, right? So those are essentially the 5 things that you get with tokenization. So the shared system of record that is something that's a big benefit. But to be honest, a shared system of record is something that you could create out of paper. The flexible custodial arrangements, that's something that you can in some jurisdictions, but not every jurisdiction, right? So remember, in the US, we have very specific custodial requirements. So not every jurisdiction gives you flexible custodial arrangements. Programmability, that you get, right? Programmability is definitely something that you get out of anything that's tokenized. And that is something that is a really important thing, because you can automatically limit what the payments are, who gets what, when it starts and when it stops. And the automation is something that should be very desirable to both the issuer and the holder, because that way you remove the possibility that the issuer can interfere. That is something that is that's really important. The next thing is the fractionalization. Fractionalization is important only to the extent that you can add in people that ordinarily maybe wouldn't necessarily be able to invest in whatever it is that you're doing. But most importantly, it's really about, remember that you're not trying to break up ownership of something. You're trying to break up a stream of revenue. And that's really what you're doing, right? So you're not really breaking out ownership. People misunderstand a lot of the ownership possibility here. And the law is very confusing, because the law favors fractionalized ownership. However, the reality favors fractionalized revenue, right? Not ownership. It's really unified ownership, but fractionalized revenue. This incongruity is one of the biggest issues, and something that Populous has resolved, right? This is something that is a major problem, because most fractionalization is going to end up being a security, and is going to end up being somehow, either you're going to have to do a registered offering, or you're going to have to do something with the CFTC, or it's going to be illegal, right? It's going to be very, very difficult for you to do these offerings. It's going to be more expensive to do the offering than the potential revenue that you'll bring in, right? Because the amount of ongoing documentation you'll have to do in the ongoing compliance is actually very difficult. Interestingly, one of the things that's still required, and we're going to talk about the requirements in a minute, one of the things that you're still going to be required to do is audits. Why? That's another big issue. Why would you still be required to do audits when you are properly tokenizing? Because all of the transactions should be fundamentally audited, right? If it's properly done on chain, not things like Tether and others that mostly operate off chain. If you are properly on chain, everything, it's like you've done everything completely on QuickBooks and all you have to do is print it out. Why would you need to audit everything when everything is fundamentally done on chain? So fundamentally, this is an issue. Composability is another very interesting thing. And this is actually the future, because fundamentally, the way that a lot of tokenization works, even though it is blowing up in the bond market, and we'll talk about that, most of this works best with assets. And we're going to have CAO, what do we call collective asset obligations, right? Instead of debt obligations, CDOs, we're going to have CAOs, right? We're going to have composite asset obligations that are going to be bundled and traded. And those are things that are going to be composed entirely of collected tokenized assets that are more liquid and more reliable than debt. A debt-based economy, which is what we have right now, is fundamentally weaker than an asset-based economy. an asset-based economy is fundamentally what this tokenized economy is going to be. So when we think about tokenization, it's not about, scammery, right? It's really about finding the right things to tokenize and then making sure they're properly tokenized and recorded, and then making sure that the streams are properly distributed. We don't have all of the technology to properly distribute. One of our biggest areas that we don't have technology to properly distribute are when you have multiple holders on that are issuers. For example, when you have multiple holders that are issuing something that need to be paid, we don't have appropriate technology that automatically splits out all of the payment. So for example, if you're talking about if you have music that you want, that you have a copyright and you have the recording rights, right? And there are multiple people in the copyright that hold interest, and there are multiple people in the recording that hold interest, and you need fundamentally a split sheet that parses out all of those rights whenever anyone gets paid. We don't have that automated split sheet for a holder. That actually is a fundamental requirement. That is something that we need. There are several requirements, things that we need in technology that haven't been built for things like the music industry, for IP, for things like that. There are things that are in the backward flow, not the forward flow, right? We have some things that are missing in the forward flow for people to buy the rights, right? To buy music, to buy whatever it is. We still have things that are missing there, but people are not working hard enough on the backwards end to be able to purchase, when these things are purchased, how do the rights get split apart? How do they get substituted? All of those things need to be created as well. But when they're created, this blockchain system will obliterate that things like $250 million worth of royalties that don't get paid every year, right? They're just sitting on desks and in bank accounts. They don't get paid out to artists, and they're just sitting there. This would obliterate that. So things like that. Okay. So the next thing is, let's talk about the state of the regulatory world in the US right now. So I just want to talk quickly about, there's a new thing that came out from the SEC that is about tokenized securities. And first, the way that the US looks at tokenized anything is essentially whatever you tokenize, the tokenized thing is essentially treated the same as the underlying thing. So if your underlying thing is a security, then the token is a security. If your underlying thing is a commodity, then the token is a commodity. If your underlying thing is nothing, then the token is nothing. That is the way that the current regulatory structure looks at it. Okay, so that's in just a very simplified view. The next thing we want to talk about is just their statement on tokenized securities, because it's complicated. And a lot of people aren't really clear on how this actually works. So here, the tokenized security is a financial instrument enumerated in the definition of security, and it's formatted or represented by a crypto asset where the record of ownership is maintained in whole or in part on or through one or more crypto networks. So basically, it's a security represented by a crypto asset. It's just crypto that represents a security. You can have two categories. One is a security tokenized by or on behalf of issuers, right? So the issuer creates the security. The other one is a security tokenized by third parties unaffiliated with the issuer. So some third party creates an issuer, it creates the token, right? That's two different kinds. If you have questions, please post them on LinkedIn, right? Because that's where I am and that's what I can see for these comments. So if you have questions, please, please, please ask them. I'm sure other people do. No one can see your comments or questions. I can, and I will answer them as best I can. Okay, for the issuer tokenized securities, right? This is stupid, right? This is a very, very stupid rule. It says that basically you have to have a master security holder, right? The master security holder file is on a crypto network. So you've got an on-chain database record alongside off-chain database records. I mean, you still got to keep a paper record. Whatever. And you've got, it tells you you've got to keep your wallet address, the quantity of security, etc. I mean, I just have to say, it's like, well, you can, it's basically you can keep an on-chain record too. Yeah. Okay. So there it says, and also you can issue a single class of securities in multiple formats. You just have to know that every offer and sale has to be registered with a commission or have an exemption. So you've got multiple different formats. You've got to register or have an exemption for every single one. And remember that you run the risk, if you've got multiple formats, you run the risk of having, even though each is an exempt offering, you run the risk of having integration and making that a public offering. The next thing you have to worry about, though, is multiples, right? Now, if you've got multiples trading of the exact same thing, you've got to be careful when you're doing that you've got one stock. Let's say you've got one stock. And if you have multiple formats of the same one stock, how exactly is that working? Who owns the actual stock? You've got to be very careful that you are not trading false stock. That is a huge problem. Do not run into FTX territory, right? Do not trade false stock. So you've got to be very careful that you are not actually doing that. So they don't mention multiples in here. I don't think they're actually considering it, but it is illegal. So I'm mentioning it. You can have a tokenized version that's a different class from another version. You can do all sorts of things, but if your tokenized version is substantially similar to another version that's already out there, and it has substantially similar rights and privileges, then they're going to consider it to be the same type, right? Which means you have to consider whether or not you're going to end up having to either register it or treat it as the same class. Remember, if you treat it as the same class, right, you have all these things like, every like 13E3 FA2, things like that, like all these rules where you have to, make the same offer to everybody in a class, right? Everybody in a class gets treated the same. So make sure that you understand the risks of opening up another group that it ends up being the same class. Are you diluting yourself? So asking about the last part. Okay, let's say you've got some common stock, or let's say you've got some preferred stock, right? And then you open up another class of what you call preferred B. But fundamentally, they have all of the rights and liquidation preference of preferred A. The SEC might view your tokenized preferred B actually as preferred A. That means if somebody wants to buy out all the preferred A, they actually have to buy out preferred A and preferred B, because fundamentally it's still preferred A. And your preferred B then gets all the rights of preferred A. So fundamentally, they get treated the same. So preferred A just got diluted. It's not preferred B. Now there's just more holders of preferred A. And if preferred A was is non-exempt for some reason, then you have to think about, did my preferred B, now is that non-exempt? Should I have done that in another offering? So you have to think about whether or not you have now merged to form two different classes into one. Hopefully that's clear. So the next thing is you can, let's see. The crypto asset can also be used indirectly to affect transfers on the security holder file, which means like the crypto asset doesn't do anything but basically notify, sorry, my neck is hurting a little, doesn't do anything but notify the like holders that a transaction has occurred. Like I want to sell something, I sell my crypto. And that doesn't actually do anything but notify the issuer that I'm selling my crypto to that person. And it doesn't actually close until the master security holder file is actually updated. This is such a weenie clause. Like, you know, what's the point of putting it on crypto if you're actually not using the crypto to close transactions? They're just saying that the on-chain database basically updates the off-chain database. You know, why? Why? Like, it's like, you know, tell me you don't understand crypto without saying you don't understand crypto. But all right. Moving on to third-party sponsored tokenized securities. This is what FTX was doing, remember, with like Tesla and other stuff where they sold tokens of securities. They did it wrong, right? So we're not going to do it that way. This is an interesting thing that they're allowing these things to be done, because originally you couldn't do anything like this. These were synthetics, right? So you sold a token that represented a security of some form, debt or stock or something. And you used to not be able to do that, but this actually allows you under limited circumstances to be able to do that, which is pretty, you know, interesting. But FTX did it illegally, right? Because they had their right. They sold tokens, but those tokens weren't actually linked to anything. There was no drawer that held Tesla stock that had a 1-to-1 ratio of tokens, right? So it was like, oh, this Tesla stock is bought up, you know, nobody can buy that anymore. And here's the token that represents it, right? Like there was none of that linking. So you got to have the linking. That would be bad otherwise, right? That's selling it otherwise. That's like just selling tokens and saying, you know, this represents my bike, right? But there's no bike attached to it, and somebody buys it, and it's, you know, like, this is for your bike, and you're like, well, where's the link? Where's the deed of ownership of my bike, right? That's attached to it, and there's nothing. And that was basically what FTX did. So we will not do that. This says that essentially the rights, obligations, and benefits associated with the asset can or cannot, right, may or may not be materially different from those of the underlying security. So you could sell a portion of the rights of the security, right? That's interesting, right? That's interesting. You could sell a portion of the rights. So let's say you've got debt. You could sell a portion of the revenue from the debt, right? You could sell a year on a 5-year bond or something. How interesting, right? You've got some interesting stuff. Great seeing you, Mohit. Hope to see you another time. So anyway, I know I'm running long, but I'm just going to try and get through this. Okay. The next is that the crypto asset may or may not represent an ownership interest or a contractual obligation of the issuer or the underlying security, and may or may not confer on the holder of the crypto asset any rights as a holder of an underlying security. So there's a lot of flexibility with this. There are 2 different models that you can have, right? So the first model is a custodial tokenized version, which is essentially that the underlying security is held in custody, and so basically that that's what FTX purported to do, right? Which is that the you know, we hold a piece of Tesla we hold the stock of Tesla, and here's the security that represents it. Here's the token that represents it, right? The other model is representing its own security that provides synthetic exposure. So that would be FTX is holding, you know, holds a bunch of what do you call holds a bunch of Tesla stock, and so or holds a Tesla fund or something, and you get a bunch of exposure holding a Tesla token, a Tesla fund token, because of FTX's Tesla token fund, right? So you're getting exposure through its holding, right? So it holds synthetic exposure because it's linked to something, like, so basically it's holding like something linked to Tesla. So that's basically what it's doing. So so for the first model is pretty straightforward, right? It actually holds the asset. The second one is a little more complicated, and this is a very new thing, but it has to be linked. The really important part is that it's actually linked to the security itself. There has to be some underlying link. It's not an obligation of the issuer of the reference security. It doesn't have rights, but the return is based on the underlying security. So it could be a derivative. It could be something like, you're getting paid, like, if Tesla goes up, you're getting paid, or it goes down, you're getting paid, like an equity appreciation. Yeah, exactly, Stan. Stan says like an equity appreciation rights agreement, something like that. And it has to actually be linked. There has to be a contractual obligation underneath it. It can't be just like a deal necessarily. It can't be just like a bet, right? Necessarily, unless it's a security-based swap, right? So a lot of these things are under the security-based swap agreement, right? Most of these things are security-based swap. Here's the thing to note about this second part. You have to be eligible to do a security-based swap. So if you are doing the linked security, you can be, to my knowledge, right? You could be anybody doing a linked security. If you are doing a security-based swap, which is essentially doing something with a referenced security, you have to be an eligible participant, right? That's the difference. So most of the things that people want to do that are security-based swaps, the security-based swaps that are essentially like, which, here's the definition. It includes any agreement, contract, or transaction that's a swap. And it's based on an index an index or a single security or loan, including interest, or the occurrence, non-occurrence, or the extent of an occurrence of an event relating to a single issuer or issuers, right? So if you're looking at derivatives, if you're looking at something like an equity appreciation rights, if you're looking at something like almost every kind of swap agreement that you're talking about, some other derivative agreement, you need to have an eligible participant. Eligible participants are essentially high net worth individuals, financial institutions, corporations. They're people who can take risk, right? That's who they are. And it usually has to be something that's traded on an exchange. So we're talking about big players in these swaps, right? Not if it's just a security, it's not necessarily someone who has to be an eligible contract participant. That's the difference. I hope that part is clear. It's just that the eligible contract participant is a much narrower group of things that you can do. The security versus security-based swap is the security part, just a security, is much smaller than the security-based swap, right? The linked security is a much smaller thing than the security-based swap. And they like the linked securities because it's attached to an actual thing. They like those better for anybody, right? Because it's actually attached to a security. So hopefully this stuff is clear. It's complicated otherwise. The way that they explain it, I find not particularly clear, but I wanted it to be as clear as possible for everyone else. Okay. What are some of the problems? Qualified investor versus accredited? Yeah, I mean, they definitely like, the quibs and qualified investors more. You can be an accredited investor because it's really a high net worth, but it's definitely more in the qualified investors, area. You're looking at, we're looking at financial institutions for security swaps. So you should look up the rules. Remember, nothing in here, and I should put it at the beginning, nothing in here is legal, financial, investment, or tax advice. But it is just here to help. It's general information. So I'm not, and I guess it's entertainment so that I don't want to get in trouble. I don't want to get anyone in trouble, but I'm just trying to help. Okay. So let's talk about the biggest problems here in asset tokenization, which is huge, right? Asset tokenization is just getting bigger. I mean, this area is, it's booming. It's like in the trillions, and it's expected to get even bigger. A lot of people are doing it wrong, right? The people who are doing it right now, the biggest areas are definitely, obviously, financial institutions, because they see this as a purely financial play, and that is what it is, right? Let's talk about the biggest problems are the regulatory uncertainty, security, and technical risks. So you have to have smart contracts that are secure. Security is really, really important, right? So this is one of the things. Do not vibe code your smart contract. That stuff is not secure, right? That stuff is not secure. You need an actual dev doing this. We do not have vibe coding and AI coding at the level of security. You need actual security for this stuff because big money passes through this. I promise you, Visa is not vibe coding these things, right? This is not what you want to have is like, your MVP, maybe you vibe code. Do not vibe code past that, right? If you cannot use your MVP to bring on real developers, then you do not have a real product, right? You need to bring on real developers who can bring on real security, which means, honestly, you're going to want as few bridges as possible. Bridges mean no security. So you want to get things that have as few bridges as possible. So that's going to be another issue, is making sure everything is fast and close to L1. And that is, for people who are not familiar, right? That's because you want certainty and closure as quick as you can for a number of these transactions. So we're going to need to focus on transactions and systems that have L1 closure quick and have speed, right? And where are we finding those things? In the Stellar Solana link, right? We've got that, the retail to institutional link right there. And they don't have a bridge, right? It's just a seamless connection from Solana to Stellar. Stellar does a lot of institutional work. So you're going to want something also that's cheap, because the whole point of this is being able to move transactions as quickly as possible. What's an L1? An L1 is a final layer, your base layer. That is where all settlement happens. Settlement happens on layer 1. No matter what people tell you about layer 2. So a layer 1 is essentially, when you look at it, you can have if a blockchain is a toll road, you can have your like rest stops and exits and stuff that go off of it. But fundamentally, in order to get anywhere, you really have to always connect back to the toll road. The toll road is the main road where everything happens, right? You can get shortcuts maybe on L2s or L3s, right? So they're layers that are kind of built on top or built on the side that shortcut things, make them faster. But fundamentally, they always go back to the layer one, right? That's why we call them ecosystems, because things can go around or faster or shortcut, but they always tie back to that layer one. So Ethereum has a huge number of things like Polygon and other things that are layer twos that were meant to shortcut proof of work systems because it was slow, but exactly the rails. Fundamentally though, what ends up happening is that they can't have final closure until they go back down and settle on the layer one, until Ethereum says, here are the transactions, I got it. That's the same thing with Bitcoin. Bitcoin has all of these other things like oh God, what is that stupid one? There's that they batch all these payments. Oh God, I can't remember it. Strike. I keep thinking Lucky Strike, but that's a bowling alley near me. Kids use it all the time. It's got like tons of like video games and stuff. It's the Strike Network or whatever it is. But all they do is they do payments between two people, but they don't close until they settle on Bitcoin. So it looks like it's closing, but it isn't really until it settles on the Bitcoin blockchain, right? So the Bitcoin blockchain is a layer one, right? All the other things are layer twos, but it fundamentally has to close on layer one, right? So remember, you want to be as close to a layer one as possible. Layer ones just tended to be very slow, but now we have layer ones like Solana that are much faster. I'm not pitching Solana. I'm just saying that one is made to be faster. Lightning, thank you, Lightning Network. But that one doesn't settle until it gets to Bitcoin. So fundamentally, one of the hardware things that are needed is a super fast one. Now, Aave is one that is, a fast layer one that isn't actually used nearly as much. So there are some layer ones that are being built, and that one gets used a lot for financial technology. So one of the things that needs to happen is the development and use, and no one cares which blockchain it is, right? The financial sector doesn't give a crap if it's this blockchain or that blockchain, right? What does it have to be? It has to be fast, it has to be secure, right? And it has to be final. That's what it has to be, right? So they don't have a stake in Ethereum versus Base versus, Solana or whatever. They don't care. They just care that it's fast, cheap, and secure. That's it. That's what they want. They don't care that it's decentralized. Nobody buys into that. Nothing is really decentralized in blockchain right now anyway. But that whole decentralization story is not the story that's winning. And it doesn't matter for tokenization, right? It doesn't matter for financial transactions. That's not the story that wins for financial transactions. That wins for ownership and identity, right? One person not owning that. But the thing that wins for finance is always fast and secure, right? Fast and secure and cheap, because the cheaper it is, the more profit you keep. So you have to remember, the same story is not the story for every single solution for blockchain. You have to remember which story matters. Okay, so interoperability and infrastructure, here's a big problem, right? One of the big problems is that a lot of the things that work for blockchain or work for tokenization don't travel well. Why do they have to travel? Because what's the point of tokenizing if you are not doing something with that token? That's one thing we're doing at Populous, right? But what is the point? What's the point? You got to make something happen with that token. You want it to just sit there? Terrible idea. Because fundamentally, What do tokens do? They allow your assets to move. You don't have to keep them in a pile under your bed or keep them in a bank earning like 0.001%. You can allow your assets to move. If you can't make your assets move, you're doing yourself no good. Don't tokenize it. If you're not letting your assets move, you are not doing your assets any good. Don't bother tokenizing, right? Don't bother. What's the point? Okay. The other thing is custody. If you don't understand custody, right? And we have a kind of a messed up custody system here because we only allow banks right now really to be custodians. And banks charge a fortune for it. And they also don't always respect the rules of custody. So custody is an issue. And the other thing is that sometimes it's impractical. A bank isn't necessarily the best custodian for a particular asset, right? Sometimes another trustee is a better custodian, or an insurance company is a better custodian, or, a landowner is a better custodian. But right now we really only have a limited ability for custodians, but your custodians must be a proper custodian. If you don't have a proper custodian, then you risk having too much liability, right? So first, you blow all of your exemptions that you might have. Second, you introduce an enormous amount of liability. Do not make yourself a custodian. Do not make yourself a custodian. That is not a good idea. That is not legal advice. That is just a suggestion. I do not recommend it very strongly, right? Do not make yourself a custodian. And the other issue is market fragmentation. That's another really big one. Market fragmentation, and we talked about regulation. So there's market fragmentation and regulation. We've talked about regulation a little bit, that our regulation is really very convoluted, and you have to know actually about 7 different areas of law in order to really understand how to tokenize. Most lawyers are not taking this on like a challenge, right? They really want someone to pay them in order to learn this area. Lawyers, stop doing that. Take the challenge, right? You have to learn these areas. You have to learn IP. You have to learn finance. You have to learn securitization. You have to learn securities. You have to learn commodities. You have to learn about economics and finance. Honestly, I know that most lawyers don't know about this stuff. I'm doing the best I can to teach people these areas, but you have to know these things in order to really understand how this technology works. Right? You have to understand these things, and you have to know AI. If you don't know how these things work, it is going to be very, very difficult for you to function with these areas, right? It's going to be very, very difficult. So for the regulation, one of the reasons we have a big problem with it is because a lot of the people who are creating the rules do not understand how these things work. And every time I hear, the David Sachs and legislators talk about this stuff, it makes me cringe because they don't actually understand a lot of these things, right? Saying that Ethereum is a big computer is wrong, right? A lot of these things they're not what they say. And it's reflected in the regulations that we're getting, and that's unfortunate. So we have a lot of conflicting information. You can see from the Clarity Act versions from the House of Representatives versus the Senate Banking Committee, they're looking at different things. They're not talking to each other. We have very siloed communication, and that results in very different, non-reconcilable regulation. And that's a big problem, right? That's a huge problem. And there's no reason for it, really. Anyway, the big problem about market fragmentation is also that we have not enough liquidity in this system. That's another thing that Populous works on. But the lack of liquidity is because a lot of people are thinking only about their side of the market. Think outside of your side of the market. Don't think just about what you're doing to tokenize something. You have to think the other side of the market. Who might want it, right? How do you build the demand on the other side of the market? How is that going to happen? That's a super important thing to think about, because lack of liquidity is really because Not because necessarily what you're doing is bad or what you're doing isn't in demand. It's because you haven't really thought about how someone else is going to find what you're doing, how someone else is going to fund what you're doing. Where is the money for this? Where's the demand? How are you going to meet each other? Building a marketplace is a very difficult thing. You have to think it through entirely, not just, can I do this? Should I do this? Is this the time to do this? How do I make all the sides of the marketplace aware of what I'm doing? It's very important that you think about it in terms of a full marketplace as opposed to merely one side, right? Don't think about these things in one side. You have to think about nearly everything that gets tokenized in terms of a marketplace and filling both sides of the marketplace. All right. In terms of, I'm not even going to get into the taxation and stablecoin issues because we have gone through a lot, but there's just so much to talk about in terms of, of that. I will say that the top asset classes by capital inflow right now are U.S. securities. These are the top asset classes that are being tokenized. Are U.S. securities, which are the treasuries, right? So 11 billion in treasuries. And major products are BlackRock's Build, BUIDL, right, which is a big joke in blockchain. Circle's USYC, right? So those are huge products, and they've got high yield, right? High yield. That is what people need. Yield, right? It offers yield. Doing something with those assets. Tokenized gold is actually huge. It's projected to reach 15 billion this year. These institutional investment funds are moving heavily into tokenized assets. So we've got BlackRock, Franklin Templeton, and JP Morgan. So they're moving heavily into it, and we see that 76% of institutional investors are moving into tokenized assets by the end of this year. I mean, that's an enormous percentage. Tokenized assets are not a small piece of the economy. They're becoming a major segment, right? This is just another thing that people hold. So you have to figure out how to make this not just part of your portfolio, but an asset that you can create, right? Tokenized equities, 3,000% increase last year. So there's $1 billion in market value in tokenized equity. And Ondo Global Markets is a big leader in this. I've got a lot to say about Ondo Global Markets. I like a lot of what they've done, actually. So it's been very, very interesting watching them. Their growth has been very interesting. So the key institutional players that we're seeing are BlackRock, Citi, and JP Morgan. And the market growth is just insane. Some areas that are growing right now, which I think are going to be interesting areas to look at, are private credit. That is an area that I love. Financing activities through tokenized assets, that is going to grow enormously. The projections are huge, 11.7%. But I mean, I think it's even going to grow bigger than that because tokenized assets are the way that you can fund the private credit market. You can tokenize. I mean, it'll take out, and I know I'm not even finishing sentences here, but you can take out all sorts of things like, oh my God, I'm just blanking on the word. But you can take out all of the funding through what is it called? Accounts receivable. What is that called? It starts with an F. How can I not remember that word? That is driving me crazy. Somebody remember it for me. I have not had coffee this morning. I have done all of this with no coffee. No coffee. Can you believe this? No coffee. It was a stupid idea, but I did it anyway. I should have had coffee. I just didn't have time. My kids got up late. All of the accounts receivable and all of those payments where you are funding factoring. Thank you, Stan. Yes, factoring. It will take out factoring and and being able to take pieces of revenue and use that for financing, you will also be able to finance works in progress, WIP, right? For real goods. If you've got WIP, you will be able to finance your WIP through tokenized assets. Tons of stuff. Invoice factoring, Donna? Yes, absolutely. All of that stuff for pennies that you control, right? Not the percentages that factors control, right? This is enormous. All of that stuff is going to be enormous. And the massive cost of private credit is going to decline because they're going to be competing with do-it-yourself tokenization. That's what's going to happen, right? So think about how much money is going to be freed by this stuff, right? So the ability, and it won't even just be financing. Think about factories being able to tokenize time, right? That they have. And trucks being able to tokenize availability so that you have LTL, which is less than truckload availability. You'll be able to do that as well, right? I mean, there's so much that will be able to be tokenized. The other thing that's moving forward quickly is the ability to do import-export through token. So you don't have all of the paperwork, and it can all be done, not just supply chain, but import-export, which is key because the length of time that import-export paperwork takes is very damaging to anything that is fungible, right? Food. Food sits on a dock and dies. But tokenized import-export can actually make that stuff go faster, right? So there's so much stuff that can be done that is growing through tokenization. And tokenizing those assets, one of the things that you can do actually is if you tokenize, say, an entire shipment, you can actually split the cost among the people who are purchasing it and give them a discount, right? So you can forward sell your shipment cost, right? So this is something that makes smaller competitors can allow them a place in industry now, right? So let's say I've got a shipment of something that I need to bring in, but I can't compete with the price of some other people, and because the cost of shipment is just too high, I can actually forward sell some of those things and bring down that price. So there are so many things that you can do with tokenization that you can't do when you have to sell the whole price, or when you don't have the ability to split it into different pieces, right? When you need one seller for everything. So other things, real estate really only works if you understand how to build in liquidity, and most people don't. So one of the things we're doing is building in some liquidity for things that have very little liquidity. I love this challenge. I love it. I love this idea of building liquidity into things that are illiquid. Why? Because fundamentally, I hate being trapped. I'm one of those people that, like, buying a house is like a huge thing for me. I don't know if this is big for anybody else, but like the idea of like, well, what if we have to leave? Like, I don't know, maybe it's the immigrant mentality, but it's like, what if we have to flee? Like, I don't like the feeling of being trapped. Yes, I'm happily married with 2 kids. So I am clearly I'm able to make commitments, but I still have this thing where I like the idea of needing liquidity. It's one of the things that attracts me the most to Bitcoin, because there's no desperation tax. I love adding that to everything. You should not have a desperation tax on any of your assets. There should be the ability to be liquid in anything that you have, because there are people that will want to buy whatever it is that you have, whatever asset you have. If it's a good, high quality asset, someone else will want it. So you should be able to get that without a desperation tax. And there's a way to do it. And there's a legal compliant way to do it. And that is what I love. So that's like the thing that is super exciting to me about this, because I love the idea that we now have this freedom. Another thing here is, intangible and intellectual property rights. We have not gone far enough in being able to do this. We started a few years ago with, I think it was Opus did this thing with IP for music. It hasn't really moved that far. And part of it is because there isn't really a marketplace that really works for moving rights. And a lot of it is no one knows what to do with the rights, right? We don't have a real market for secondary rights. What happens if you buy, Beatles songs? What do you do with them? Do you have a connection to get them remade or have artists redo them? There's still a limited market in what to do with those rights, right? That's the real issue. Again, you've got to think through the marketplace when you create these things. I know I'm pointing a lot. I don't mean to be offensive about that, but I don't know why I do that. But anyway, so you have to think through these rights in their entirety, right? Which is, yay, I want to be able to buy and sell rights. And the artists are like, yeah, you can have a portion of my rights. And you have a retail investor who's like, yay, I've got 1/100th of a Mariah Carey song. And then you're like, well, what do I do with that? Right? You could have revenue coming in, but you have no way of actually getting something from this, right? You've got no way of doing, of making money from that. You don't have a real marketplace for that because you don't know how to monetize that. You got to think through the whole thing. Stan, was lovely. I'm so glad you joined. Thank you so much, and I look forward to talking to you. All right. So patents, licenses, all of that stuff, think through those marketplaces and build them because that's coming. Revenue sharing, we talked about. Some things like carbon credits, green bonds, things like that, those are actually coming too. I kind of think carbon credits are stupid. I don't even kind of think that carbon credits are stupid. I actually think carbon credits are stupid because it's basically just paying somebody to be allowed to pollute. It doesn't actually encourage anybody. People who don't pollute. And people who do pollute just have to pay the people that don't pollute to be able to pollute more. It doesn't do anything to encourage people who pollute to not pollute. It doesn't do anything to do that, right? It's just transferring money from the people who pollute to the people who don't pollute, but it doesn't change anyone's behavior. Carbon credits are a flop. They didn't actually do anything. So it's a really stupid idea. It doesn't do a damn thing, but yay, they're out there. I don't really get it. And also all of those carbon credit programs where, you plant trees or whatever, it turns out about 7% of that is actually ever done. So I don't know really what people are paying for. It would be nice instead if all of the people who I guess over polluted had to plant an equivalent amount of trees, maybe. That would actually be something to offset the amount of carbon that they produced, right? They had to plant the overage in trees somewhere, right? But at some point we'd have enough trees and they're still polluting. Then what do we do? I don't know, right? I really don't know. But somebody has to think this through better because nobody's changing their behavior. They decided the penalty is less than the profit. So this didn't work. The end. Okay. Another one is, fine arts and alternative investments, luxury goods. Those are moving up. We all know about those. Those have been going on. And private credit, institutional funds, trade supply chains, things like that. We've talked about those. Let's see. Operational and structural challenges. We've talked about a lot of those. We've talked about a lot of these. Okay. So who should not do this? I'm gonna end on this one. Who should not do this, right? So I haven't talked much about bonds or things like that. It is shaking up the stock, bond, and crypto markets. And it's definitely happening in the bond markets. The bond markets are definitely pumping, and they're you're fractionalizing bond markets. Now, here's the problem, though. People are buying tokens on bonds. they need to understand, if they're buying packages of bonds, especially, what that underlying package looks like, and they're buying appropriately, like the appropriate level of risk for them. They're not actually buying bonds that are too risky for them, et cetera, right? So you have to be careful when you're buying bonds that you're buying something that is risk appropriate. And that is something that, we're seeing, right? We're seeing people that are actually, buying inappropriate level bonds. But the bonds right now primarily are just treasuries. And for those, buying a smaller portion of treasuries, et cetera, it is what it is. It's just treasuries. So, there's a lot that's happening. We're seeing a lot more tokens happening. The one thing that I don't want to see are tokens that are happening like the stable coins from the banks, because those don't go anywhere. Those aren't even used. The stable coins that banks issue under the Genius Act sit. They don't do anything. They don't trade. They are literally just a representation of your deposit. And it's only because they don't want to actually pay out any sort of interest. So the tokens that they use that actually get like moved in the system are deposit tokens. They're a completely different token. You don't want to create tokens that don't move. You want to create tokens that actually move, right? Not tokens that are just a representation of something. We keep getting regulations that contemplate tokens that are just representations of things. That's not functional. You need to have tokens that actually move. They have to do something. Otherwise, why have a token? What is the difference between a token that represents something and the thing that in the paper that represents something? The difference has to be that token can do stuff. It can go into things, right? It can go through, like, it can be used as collateral for something. It can go through an application or whatever, right? It can go through a protocol. It can do stuff. You have to have stuff to do stuff, right? If it doesn't do stuff, what's the point? So what shouldn't be in one of these protocols? I know it's like an hour and a half, which is way longer than I usually go. Low value, high velocity physical goods. These do not belong on tokens. Why? Gas fees? They're super expensive. It's expensive to do it. It's not worth it. Don't put your cheap crap on tokens. It's not worth it, right? It's not worth it. It's not worth the cost, right? So you don't need like a digital representation of something, of like consumer goods or things like that. Those are not great things to trade. If it's like a very high-end luxury good, that's one thing. But your $300 sofa, no, it's not worth it, right? It's not worth it to trade, to tokenize it and trade it, right? The only thing that might be worth it to tokenize is something that you need to have an ownership for, right? Like high-end sneakers or that luxury purse. But again, we're in luxury, not common consumer goods, right? Common electronic goods, common goods, right? You don't want those things being tokenized. It's not worth it, right? So other things, perishable things other than things for like, import, export, large volume. If you're doing large volume, that's different. Small volume perishables, not worth it. If you're doing things that are of subjective quality, you don't want those to be tokenized, right? Things that are like, a haircut, right? Or services that don't come from a particular person or guarantee a particular quality, right? A dog walk or an hour of consulting. Well, it has to be tied to a person where you know the quality, right? Not just an hour of consulting, even from a particular agency, unless you know every single person in that agency is high quality. Otherwise, it has to be tied to a particular person. Otherwise, it's not worth it because you don't know if you're going to get something great or something terrible, right? So variable quality is not worth it because it'll be hard to find someone who's a buyer for that amount of that particular variable quality, right? You don't know what you're going to get. So it shouldn't be something that is a service or something that is that could vary in quality. Something that has a linkage problem, something that has that you can't validate, right? So you need to have something that has verified ownership, right? You have clear title to it. So if you've got something where you're transferring something, but the government only recognizes paper deeds, you're going to have a paper copy also. If you have something where there's a break in ownership, you only have quitclaim title or something like that, or you've got back of the truck ownership, you should not tokenize that, right? Because you don't have clear ownership, right? If you've got, if you've got something where it is, what is it, that the jewelry that was stolen from the what was it, the Louvre, in like 10 minutes or whatever it is, like if you've got that jewelry, don't tokenize it, right? Because I mean, you clearly don't have ownership of it, and whoever has it is, immediately it's going to go back to the Louvre, right? It's not something that's yours. If there's something that is, if there's something that's unsecured personal property, right? If there's something that is like a pearl necklace or something like that, if it's not attached to ownership, right? If there's not a chip or a link, or if there's art that doesn't have a link to ownership on chain, then you can't tokenize it, right? But now you can get it chipped and linked, right? It just have to do that. Otherwise, it's like a floating thing, and you're saying, oh, that necklace is being transferred or whatever, but to the holder, you actually have a legal problem called bona fide purchaser, right? There's nothing there telling somebody who purchased it on the street that there is a potential ownership issue that someone else might own it on chain, right? So you have to have something that connects it on chain that you could tell there's an ownership on chain, right? That they should go look and see who the owner is and make sure that the person selling it to you is that owner, right? And that your ownership is added on chain. So you should have like conspicuous ownership that is connected to that physical object. Hopefully that's clear. And then there are some things that, like things that have huge amounts of liability. I'm kind of back and forth on this one. Things without liability, things with heavy liability, you can tokenize ownership of something with heavy liability, but you must have the risk attached to it, right? You must have the risk travel with it. So that's the issue, is that it's on you to make sure that buyers have knowledge of the liability attached to it. So just make sure that you have informed buyers. That's it. Otherwise, you have problems later on. Let's see. The other thing is, if it's something that has high liability, consider making sure that you have insurance, right? And the insurance is attached. Okay. Let's see. Do I have anything? I mean, I have a million things more, but I'm going to save that. There's so much more about how you implement a lot of this stuff. But I'm going to stop here because it's already more than an hour and a half into it, or it's about an hour and a half of actual information. So that's about my limit on how much I'm going to do. I always have so much more. But if you're interested in what I'm doing with my co-founders and Populous, you can always look at populous.co. I think it's www.populous.co. If you are interested in more information from me, you can look at the Damsker Report, which is on Substack. Follow me here on LinkedIn, and you will see my I do this weekly. You'll see my my economics and markets reports. I'm doing these every week. I'm doing them on Thursdays. Next week, I happen to have a conflict, so I usually do them at 10 a.m., Pacific, but I'm going to do the next one at 4 p.m. Pacific. And it is on AI and intellectual property and how to protect yourself, how to create IP that is not replicable by AI, and how to use AI responsibly so that you don't interfere with IP, and how the LLMs actually work, just so you understand how the technology is actually working. There are a lot of people that think it is something that it is not. So please share, let everybody know that I'm doing these things. I hope they're very helpful. And I don't really know what else to say because I, again, have not had coffee. I really appreciate all the comments and the questions. They help a lot. They let me know what to say and what not to say. I'm going to try and bring guests on whenever I can. I was not super able to do that. I wasn't prepared enough to do that because I was away in the Caymans last week. And so I was not able to do that for this one, but I will try and do it for the AI one if I can. And let me know in advance if you have any questions or comments. And I look forward to seeing you next week. I guarantee you're going to have information that you didn't have before. You will learn something, and it will be as entertaining as I can possibly make it. I will try and have coffee. So take care, everyone. Have a great weekend. I will see you next Thursday, I believe at 4 p.m. Pacific. So take care, everyone.